Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing NLY stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. NLY is one of the largest mortgage REITs. The company borrows money and then invest that money into asset-backed securities. Most of the company's assets are mortgage-backed securities issued by either Fannie Mae or Freddie Mac. Fannie and Freddie are considered almost risk-free because they are backed by the government. The government took over Fannie and Freddie to stabilize the economy after the financial crisis of 2008. The way this company makes money is the interest spread between the interest earned from its investment and the interest they pay on its debt. And that's amplified from the use of leverage. When you hear the word leverage, it just means debt. A lot of REITs we discussed on this channel own a physical property, such as a shopping center, a hospital, a prison, etc. This is a mortgage REIT, which means it owns mortgages or mortgage-backed securities. It has exposure to residential and commercial mortgages. I have a lot of experience working with mortgage-backed securities when I worked in Manhattan. I worked on mortgage-backed securities, asset-backed securities, commercial mortgage-backed securities, trust preferred securities, CDOs, CDO squared, all different asset structures. You need to realize that if there's an increase in interest rates, that would translate into a decrease in mortgage REIT book values, which would drive NLY stock price lower. Because as interest rates increase, the value of bonds fall. And as interest rates decrease, the value of bonds rise. The company is headquartered in New York, New York. It was founded in 1997. It trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $8 a share and they have 1.5 billion shares outstanding. Here's the company's income statement from their 10K. This provides the full year 2018, 19, and 20. We're going to look at their 9/30/2021 income statement right after this. As I said earlier, the revenue they receive is on the interest spread. So you can't really use Yahoo Finance and most websites to understand their financials, because a lot of the data is wrong, because those websites have programs to look for revenue to pull that into their software, and there's no revenue, so it gets all screwed up. So you really have to look at the company's K's and Q's to see their actual financials. And I'm doing this video different than I do most videos because this is the first time I tried to value a mortgage REIT. I'll try to explain as much as I could, but it is really confusing and complex. So you can see the interest income has decreased. It was 3.3 billion. It went up to 3.8 billion. Now it's 2.2 billion. Because the interest received is really based off of the interest rate in the market. But their interest expense went down a lot as well. So in 2019, their interest expense was 2.8 billion. That's how much it cost them to borrow money. And now it's down to 900 million. So their net revenue or net interest income is higher in 2020 with a lot lower revenue. But then there's a lot of other things going on. They have interest rate swaps, so those move a lot as well. And when their investments matured, they had big losses, 1.9 billion in 2020. They did have a small gain in 2018. And they currently have an unrealized loss of 900 million on their interest rate swaps. They also sell some investments before they mature, also exercise some derivatives before they mature. They had a gain on those in 2020. They had an operating loss of 2 billion in 2020. So every year they have an operating loss. It's so much better to look at the statement of cash flows so we could track actual cash. Trying to understand all their realized and unrealized losses, especially when there's derivatives involved, it can be a little confusing. So they had a net loss of 900 million in 2020, a net loss of 2.2 billion in 2019. In the third quarter of 2021, they had a net gain of $500 million. In the third quarter of 2020, they had a net gain of 1 billion. So their income statement looks a lot better in 2021. For the first 9 months of 2021, they had a net profit of 2 billion. If you're thoroughly confused, don't worry, I am a little bit as well. It's hard to make heads or tails of this, especially when they throw in swaps and derivatives. When you buy a stock, you want it to go up, right? And if it goes up, you make an unrealized gain. If it goes down, you have an unrealized loss. But what if it goes down and you make more money because you bought swaps to hedge yourself? So how can you possibly model that out and figure out how much money you're going to make in the future? Because if it goes up the stock, you make money, but you don't make as much money because you bought swaps and it limits your upside. But when the stock goes down, you don't know how much money you're going to lose or possibly make. And when it goes up, the same thing, because you don't really know the theta of the derivative. Here are their operating cash flows from their latest quarterly report. Operating cash flow is net income converted to cash. So maybe this will be a little clearer. The way to calculate operating cash flow, you start with net income or net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with a net gain of $2 billion. That was for the first 9 months of 2021. We have to add back $500 million of amortization of premium and discounts. Bond premiums and discounts occur as interest rates change. So a bond discount is the amount the market price of a bond is lower than its principal amount at maturity. A bond premium is the opposite, and the company has to amortize these differences. They had a loss of $1 billion on their derivatives. Even though they reported an accounting profit of $2 billion, they actually generated $2.2 billion of cash flow. Last year it was an accounting loss of $1.8 billion, but they only lost $339 million of cash flow. The derivatives went the other way. In 2020, they passed through a loss on their income statement, so they have to add it back here on the statement of cash flows. Here's their investing cash flows for the first 9 months of 2020 and the first 9 months of 2021. They purchased $18 billion of securities in 2021, $25 billion in 2020. They received $11 billion from the sale of securities. They received $15 billion from the principal payments on securities. They spent nearly $5 billion on the origination of loans. Most of the money the company receives is from repurchase agreements. Repos are short-term debt for companies that deal in government securities. They also have reverse repurchase agreements, or reverse repos. This is the purchase of securities with the agreement to sell them at a higher price at a specific future date. They borrowed $15 billion on reverse repo this year. Last year was $46 billion. So in their investing section, they had a cash inflow of $6 billion. Last year was a cash inflow of $40 billion. In their financing section, they borrowed $1.7 trillion from repo agreements. Last year was $2.4 trillion. They paid down $1.7 trillion in repo agreements this year. So they pretty much just roll their debt year to year. Pretty much everybody who buys this stock is doing so for the dividend. They paid out over $1 billion in dividends this year and $1.1 billion last year. This is just for the first 9 months of 2021. So in all of 2021, they paid more than $1 billion, probably around $1.3 billion. In their financing section, they had a cash outflow of $8.8 billion. Last year was a cash outflow of $40 billion. This is their historical free cash flow. So you can see in 2013 and 14, they had a big negative. It was over $10 billion in 2008 and 9. If interest rates drop a lot or increase a lot, that can hurt this company. If they drop a little or increase a little, that's usually fine because they hedge themselves. This is the equity section on their 9/30 balance sheet. They have $14 billion of equity. They raised $1.5 billion from selling preferred stock. Preferred stock is a hybrid between debt and equity. They raised $20 billion from issuing common stock, and they have an accumulated deficit of $10 billion. Accumulated deficit is a sum of all their prior net incomes minus the sum of all the dividends they paid out. Only one of the past 5 quarters, they had a net loss. In the third quarter of 2021, each shareholder received 34 cents of net income. They didn't actually receive that money, but each shareholder had a lien of 34 cents on their net income. They paid out 22 cents of that 34 cents. Their book value per share is $8.39. In the first quarter, it was the highest at $8.95. The net interest margin is a spread they receive. It's how they make money. The higher the better for this. It was 2% in the third quarter. The reason the yield is higher than the net interest margin is because they receive principal payments as well. With the principal payments, they're making $2.29 for every $100 they invest. So you can see they're a bit leveraged. Their GAAP leverage was 4.4. Their economic leverage was 5.8. Leverage is debt over equity. So for every $1 in equity, they have $4.40 in debt. Most of their portfolio are agency MBS. These are Fannie and Freddie, which are government-sponsored entities. That was $63 billion. They have $787 million in residential credit risk transfers, non-agency of $1.7 billion, and CMBS, commercial mortgage-backed securities, is $269 million. They also have $1.7 billion of mortgage loans, $1.9 billion of corporate debt. This is debt backed by the full faith of the company that's issuing the debt. So they could have bought debt issued by a company like Google or Facebook. So their total investments is $75 billion, which is down from last year of $87 billion. The change in interest rates directly affects the size of their portfolio. The interest spread is really important as well. Say, for example, they had a portfolio size of $100 billion and the interest spread was 2%. That means their income would be $2 billion. But if their portfolio was $80 billion and the spread was 3%, they would make $2.4 billion. So they would make more money with a smaller portfolio. So the portfolio size is just one part of it. It's also the spread as well. Here's their quarterly net income or net loss. So for the past 5 quarters, it was positive except for the second quarter of 2021. Even in the second quarter of 2021, they had positive earnings that were available for distribution, even though they reported a net loss on their income statement, because they had $141 million of gains on interest rate swaps and $357 million of gains on other derivatives. So you don't want to just look at net income or net loss for this company or any company, but especially for companies like this. Here's their quarterly repurchase agreements. That's how much money they borrowed. It was $56 billion in the third quarter. They also borrowed money from other sources, so total borrowings were $61 billion. That's according to GAAP, generally accepted accounting principles. On a non-GAAP measure, it's $55.5 billion. Their economic debt, which takes into account derivatives, is $80 billion. So their leverage is 5.8x, which is lower than 6.2 from last year at this time. The leverage ratio is debt over equity. And one of the most important things to look at is their net interest margin, which was 2.04%, down a little from the second quarter of 2021. The interest spread is the difference between how much they pay on their debt and how much they receive on their investments. And this chart shows you how much money they earn from their assets, $72 billion, and how much they pay in their assets, $62 billion. If a lot of people start defaulting on their mortgages, then they're not going to receive the principal and interest payments on their investments, and they're going to lose a lot of money. I don't foresee that happening like it did in 2008. But people definitely default every now and then. And it may be a little higher than in most years, but I don't think it's going to have a dramatic effect. Plus, the way these vehicles are structured, anywhere from 10 to 30% of the borrowers can default before the bondholders take a loss. Simply Wall Street values the company at $10 a share. They're saying it's 20% undervalued. 8 analysts priced this stock and the average price target is $9. The low is $8, the high is $9.50. This is where the stock has been trading the last 2 years. All stocks that are tied to real estate crashed in March 2020. Definitely more so than the average industry. The stock has pretty much doubled since its lows. If you bought it down here, you'd be earning like a 25% dividend. Their portfolio is $94 billion. $87 billion are from government-sponsored entities, Fannie, Freddie, and Ginnie. I remember when I first started working, someone asked me to bring this paper down to Ginnie Mae. And I actually thought there was a person named Ginnie Mae. But my coworker was just referring to the trading desk for Ginnie Mae. They have $1.9 billion in private equity middle market businesses, $4.3 billion in residential credit. This is also mortgage-backed securities, but they're not backed by the government. These may be mortgage-backed securities issued by JP Morgan or maybe Morgan Stanley. Their beta is 1.26, so the stock moves a little more than the market. It's gone down 2% in the past 52 weeks, but it's gone up a lot if you include the dividend. The S&P has gone up 29%, The 52-week low is 767, the high is 10. And the stock is on a decline, trading below its 50-day and 200-day moving average. And this is a really popular stock. Over 20 million shares have been traded each day the past 10 days. All the shares outstanding are on float. 44% are held by institutions, and 3.5% of the shares are shorted. They pay a really nice dividend of 11%. They paid a 30-cent dividend back in 2017 or 18. But the stock price was a lot higher then, so the dividend yield was similar. The average dividend paid in their industry is 9%, so they're much higher than average. And analysts are forecasting them to grow their dividend to 11% from 10.9%. So analysts are indicating the dividend is safe. This is their historical dividend. And most years they paid over 10%. There was a time the dividend dropped, but they were paying over 15% at some points. Over 14% here. So it seems like a pretty stable dividend. It seems like they'll be able to continue paying this. REITs don't need many employees, but it seems like they've hired a lot of people recently. It must be through an acquisition. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $16,000 today. That's only a 5% annual return. The only insider activity I found was a sell of 80,000 shares back in May. The general public owns 56% of the stock, institutions 44%. Vanguard owns 9% of the company, 128 million shares valued at $1 billion, then BlackRock, State Street, Allspring, and Geode. Let's look at their financial ratios. They have amazing price multiples, a PE of 4.1. A price to sales of 3.8 and a price to book of 0.9. Here's a list of their current assets: $1 billion of cash, $65 billion of securities, $3.6 billion of loans, $4.7 billion of assets transferred to their securitization vehicles. So they have $77 billion of assets. Let's look at their liabilities. They have $55 billion of repo agreements, $4 billion of debt issued by securitization vehicles, $900 million of derivative liabilities, so they have $63 billion of liabilities. The best way to look at ratios is to compare them to companies in the same industry. There are 26 companies in the same industry as NLY, and NLY is the biggest company of the 26 in terms of market cap. They are more leveraged than average. The average is 3.3, they're 4.4. They do pay a higher dividend than the average company. Average is 8.7%. Orchid pays 13.7%. Cherry Hill pays 13.3%. The dividends on REITs are taxed at the higher tax rate, not the short-term capital gains rate, like a traditional dividend is taxed on. So you have to take that into account when you have a REIT. You're paying the higher tax rate. They generate much more free cash flow than anyone else in their industry. They have the largest market cap. Their price to book is about average. Their price to earnings is a lot better than average. Price to earnings generally isn't a good indicator for REITs. You want to look at price to funds from operations. Price to free cash flow is good to look at when valuing a REIT, and they're much better than average at 3.8, average is 13.5. Their price to sales is a lot better than average. They generate the most revenue of any company in their industry. Their 5-year annual revenue growth rate is 43%, which is really high. Dynex is 50%. Their ROA and ROE are better than average. So to summarize, I didn't really value this company because I thought it was too difficult. But as I do more mortgage REITs, I may get a better handle on it and feel more comfortable giving an actual dollar amount. But I tried to give you as much information as possible to give you a better idea on what this company does. I know it's not that straightforward, but I think I'll get better as I do more of these types of structures. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.